Hello, everybody.
Hello.
Tiana, Janet. I'm going to mute you, Amy. All right, we're going to get rolling here in just a minute. People are filtering in. We're going to go live here. And we are live streaming on Facebook too. This is my first Facebook live stream, everybody. So we'll see how it goes. Okay. One more minute here and we'll get this thing started. Thanks everybody for joining. Hope you get some good information out of this today. I hope you can all hear me okay. Did a quick audio check and it seemed to be all right. All right, it's noon. Let's get it going. So thanks everyone for joining. We're going to be talking about the home buying process, getting pre-approved, some tips and tricks and things like that. A little bit about me. I've been in the business for about 17 years. We've closed over 7,000 transactions in the last 17 years. We work exclusively by referral, my team and I. I'm supported by 7 great people who work with my clients to set up loans and keep communication flowing, helping with setting up webinars and things like that. But we work exclusively by referral. You're not going to see my name on a ad on a bus stop bench or on the radio or anything like that. Mainly focused on purchase business. We certainly do refinances when rates drop, but we mainly focus on helping people get into homes and purchasing homes. And we work as I love working as an advisor in a consultative basis. We're not order takers at the end of an 800 number. We like to really get to know our clients and know what's important to them and try to tailor a solution that fits their needs. So that's a little bit about me. I work across country, one of the larger mortgage companies in the country, about $50 billion a year in loans. It's all we do. No checking or savings or anything like that. We sell direct to Fannie and Freddie. We have a lot of different loan products because of our size. A lot of investors like to work with us. And we have a lot of solutions where some people, if you can't find financing, we can usually find a good solution for you. We do everything local, underwriting, getting the loan docs ready, funding, all of that is handled under one roof. We don't usually send anything out unless it's a really oddball type of transaction. And everything's digital. So online application, you can upload your documents, online and stuff like that. So that's a little bit about us. Now, what we're going to cover today over the next 30 minutes, it's going to be about a 30-minute webinar. Pre-approval process. We're going to talk a little bit about credit, income, and assets. Those are the 3 big pillars. The home buying process. And the first thing I want to start off with is how do you choose who you want to work with if you want to get a mortgage? So choosing a lender is tricky. There's a lot coming at you as soon as you start to look, with the different kinds of tracking and everything that's done right now. When you go online to different places, you probably start to get bombarded on your phone and email and everything about, work with me. So how can you tell one from the other? These are some big questions to ask. There's basically 3 ways that a loan can get originated, we call it, either through a retail bank, a broker, or a direct lender like us. Retail bank is like Chase, Wells, B of A. You walk in, you work with a lending person there. You're limited though to the products they have. And that's usually the downside of working with retail banks is you don't have a lot of variety when it comes to choosing between different products, different interest rates, taking advantage of different lenders in different markets. So, there's some disadvantage there. A broker is somebody who takes your application and sends it off somewhere to be underwritten and funded. So there's not a whole lot of control there. Usually they know a lot about the loans, the loan process. There's some really good brokers out there, but when it comes time to actually, get your loan done, they don't have direct access and direct control over the process. A direct lender like us, we're kind of a mix of those two things. So because of our size, we've been given the delegated authority to be a direct lender, meaning that we get guidelines from investors and we underwrite draw docs, fund loans right here. We have total control of the file. If we need to switch products at any point, we don't have to send it to a different place. So a direct lender is where I've chosen to work, and I think it gives the best advantage to borrowers. If you're getting a conforming loan, so conforming, conventional, agency, Fannie, Freddie, these are all interchangeable terms. You want to know that the person that you're working with can sell direct to the agencies, better rates, better terms. Who does your appraisals? Appraisals could be a deal breaker in certain situations, right? We own our own appraisal management company here. That's something important that you want. Are they using all local appraisers who are familiar with the market? And how many different loan options do you have? What we call investors in the mortgage world. So what's the array of different lending options that you can offer? How many days does it take for you to close a purchase? Often that's the make or break again on whether you get your offer accepted, how quickly your lender can close the deal. Do you fully pre-underwrite all of your files? So is the person that you're talking to just going to take a quick look at your income, assets, and credit, or will they actually give it to an underwriter to be fully underwritten like we do here? You can give them a sample scenario. Some people don't like to give rate unless they've actually pulled your credit and done all those things, but you can certainly give someone a scenario that I have excellent credit. This is my loan amount. This is my down payment. What's the ballpark rate that you're offering right now? And what are your fees? So different lenders have different fixed fees that you'd have to pay for at closing, and you want to have a good idea of what those will be. The other two big things are the security. The loan application is the holy grail of identity theft. So you want to make sure that when you're giving somebody on one piece of paper your name, address, social, birth date, bank account information, credit card information, where you work, how much you make, that information is secure. So you want to make sure that they're using at least bank level security, the same kind of security as when you log into your bank. And then what's the privacy policy? The privacy policy has to do with your personal information. You don't want that stuff floating around out there where all of a sudden, you work with somebody and then you get bombarded by all their subsidiaries and, they sell it to different marketing companies and things like that. So you want to make sure that these are all the criteria that I would, I'd have a little checklist of questions here on choosing who to work with. Once you've chosen someone, now it's time to get pre-approved. And that's all about looking at your income, your assets, and your credit. So I'm going to take a little bit of a deeper dive into each one of these areas here. When it comes to income, there's basically two boxes. The first box is, are you a W-2 wage earner? The general documentation requirement, if you're a W-2 wage earner, are 2 years of W-2s, 30 days of pay stubs. If you get bonus or commission, we're going to have to get some additional information to document how much you've received over the last couple of years. Again, if you work a lot of overtime, that's something that we're going to have to average out over the last couple of years to see the consistency of the overtime. If you have a second job, a lot of people might have two forms of employment. That second job needs to have been there again for at least 2 years so that we can see the consistency of it. A lot of W-2 wage earners, especially here in Silicon Valley, a lot of tech companies pay with stock. A portion of your compensation is what we call RSUs, restricted stock units. If you're getting RSU income, then there's, again, a little bit more paperwork involved in getting your vesting schedules and things like that. But this is the first bucket, and we would get all this information in order to analyze how much you make. Now, a lot of people will think that they make one thing in the real world, but when it comes to underwriting, that number might be a little bit different. So it's important, again, to get fully underwritten, fully approved so that you know exactly how the underwriters, how the lenders would view your income versus what you think it might be, what you're earning out there. The second bucket is self-employed. So if you are self-employed, there are a lot of alternate products out there available where you don't necessarily have to have the 2-year history, but when we're talking about the A paper, the traditional lending model, we need a 2-year history of self-employment. A lot of people have employed themselves when they have a side corporation. If you've incorporated and you pay yourself as a W-2, for lending purposes, that still counts as self-employed. So, anytime you own more than 25% of any entity, that's viewed as a self-employed borrower. There's some new rules that have come into effect because of COVID. So many self-employed people were negatively impacted by the shutdown that we're having to get updated profit and loss statement for the year. We're having to get balance sheets. We're having to get instead of just looking at the last 2 years of tax returns, we're having to see exactly how everybody's been impacted now. And that's supported through business bank statements and through seeing the activity. Is the business still open, and is it still, maintaining that same level of earning as it was the last couple of years. And those are the basic two. Now, there's other forms of income. Certainly, there's pension, there's retirement, there's Social Security, there's some asset-based programs where you can turn your assets into income. So these aren't the only, but these are the basic two. If you guys have any questions outside the box there, then I'd be happy to answer them, at any time. The second thing we look at are your assets, right? So the one big rule: you can't have cash. You can't have mattress money and show up at the closing with a couple of $100,000 of cash. It needs to come through a bank. So the way we source that is that we need 2 months of bank statements. Now, if you got a gift from your mom that was $100,000 back in February, we don't necessarily need to know about that or see it, because right now, since we're in August, we'd be looking at your July and June bank statements, and that's all we would see is whatever the activity was there. We do have to source any large deposits. Large deposits are considered any kind of a deposit that's more than 50% of your gross income. So if you make $10,000 a month, any deposits over $5,000 have to be what we call sourced, which is, where did this come from? Are you going out and getting another loan and borrowing money from someone, or is it a legitimate deposit that's going into your account? Gift funds are fine. For just about every program, you can use gift funds during the transaction. You don't have to receive them into your account. You can just let us know that, or your lender know that the gift funds are what you're going to be using, and then we can furnish you with a gift letter that gets filled out by you and the donor. It does need to come from a family member, and it can't be a friend. It has to be a family member, fiance, spouse's family, but there has to be some familial relation generally when you're getting the gift. If you're getting a jumbo loan, and jumbo loans are considered to be loans in our area, in high cost areas, anything over about $832,000, then you're probably going to also need some kind of reserves, which means there needs to be some money somewhere after you close. You can't use every last penny to buy the house. So that reserve money could be in stocks. It could be in your 401k. It could be, cash sitting in your bank account. But for jumbo loans, there's a reserve requirement. Conventional lending does not have a reserve requirement generally. You can, theoretically use every penny that you have, and that's it. Drain your accounts and purchase a home. I don't advise that. It's not a good idea, because owning a home is costly. You want some reserves, but from a qualification standpoint, you don't have to show any additional funds. Now, quick tip: when you're pre-approved, don't move a bunch of money around. It's not a deal killer necessarily, but it does increase the paperwork. We have to track money moving between accounts. Perfect scenario: you've got your down payment and it's sitting somewhere, and you just leave it alone, right? In an account that doesn't have a whole ton of activity. If you've got a savings account somewhere that, you can park the money, that's perfect, versus having it in checking where you have a ton of transactions going on, because all those transactions get viewed and analyzed and could lead to more questions. So a big tip is, don't move the money that you're targeting around between accounts too much. So the other asset thing is, how much do I actually need, right? And it depends on the loan program that you're going with. So a VA loan for vets, either current or former members of the military who have not used up their eligibility, 0% down, no mortgage insurance, really low rates. It's a great loan. FHA allows 3.5% down up to $822,000. Conventional is 3% to $548,000, and then 5% down to $822,000 in the high cost area. So the national conventional limit, and by conventional, we're talking, the terms are Fannie Mae, Freddie Mac, agency, conforming, conventional. All these terms are interchangeable. I say that to people all the time because they get confused about one or the other. That's all one bucket. So the national conforming limit, which gets set every year based on median home prices, this year happens to be $548,250. And there's been an exception in place since the financial crisis where the agencies, Fannie and Freddie, will allow loans up to 150% of the national number in high cost areas like New York, LA, the Bay Area, places like that. So the high balance area is 822, 375 with 5% down, meaning that you could purchase a home, for $850,000 with about $45,000 as your down payment in those areas. Jumbo, we have 10% down up to $1.5 million loan amount. That actually just got expanded last week to up to 2 million. So you could get a $2.2 million house with 200,000 down. And if you don't have any down payment, there are a lot of really good state and local programs that have down payment assistance. So there's two agencies that we work with in the state of California. One's called CalHFA, the California Housing Finance Authority, and the other one is GSFA, the Golden State Finance Authority. And they've got all kinds of programs that can help you out a little bit with down payment, up to about 3% and the closing costs. So if you've got your down payment, but you don't have the closing costs, they put a small loan in place to cover those closing costs. A couple of these programs are interest-free loans as well. So if you're struggling with assets and down payment, make sure to ask your lender about assistance there. There are income qualifications and limits on the loan amount. So in the higher cost areas, they don't really apply, but for traditional, conventional, or FHA loans, they could be a good option. So once we've got income and assets down, the next question is, how's your credit? And the credit's a big deal. It becomes a big deal not only for your eligibility, but your pricing as well. So both of those things are huge factors. And a lot of people don't know, where does my FICO score even come from? How is it constructed? Well, you can see on this chart, 35% is your payment history. That's the most important thing. So don't be late on any payments. That's critical. 30% is how much you owe on the accounts that you have. And then another 15% is the length of your credit history. So 80% of your FICO score is based on how long your accounts have been open, what the balances are, and what your payment history is. Inquiries, which people really get concerned about, makes up a very small percentage of your FICO score. And a mortgage inquiry is the least impactful of all the credit inquiries. The worst is consumer credit, places like Macy's, Home Depot, Target, consumer credit like that, like the Gap. The next worst is credit cards, Visa, MasterCard, Amex, Discover, followed by auto loans, followed by mortgage. So mortgage is the least impactful on your credit. You're probably looking at maybe 3 to 5 points at some point down the road, about 45 days after the inquiry. So it's not instant. And the main thing is managing your balances. That's the one area here that you really have control over immediately. Payment history, if you have a late payment, there's not much you can do about it. So make sure you pay stuff on time. And the length of credit, not much you can do about that. One tip, if you guys have kids, get them credit cards early. It'll help them have a really strong credit score. So credit cards that have been open for 10 years plus really help your credit score. You don't want to close any of those accounts, but managing your balances is a really big factor. So when it comes to, what is good credit, right? So the very best credit is something, 800 and above. That's generally what we call, the best credit scores. Anything 740 to 799 is excellent. It's still very good credit and you get great pricing. 740 to 700 is also good, but your pricing gets negatively impacted. Anything below 680, you start to really get into, from a mortgage lending standpoint, into the areas where it gets a little bit trickier to try to get the very best interest rates. It's just not possible. The very baseline lowest credit score that we can use is 580, and that's with FHA. Conventional is a 620, and our minimum on jumbo is 660. Now, here's a big tip for you guys on credit. If you're looking to get pre-approved, pay down your credit cards, if at all possible, to as low as you can before you get your credit pulled. It's going to have a significant impact on your credit score. I've seen credit score change 50 points based on somebody going from a maxed out credit card to paying it off. So it's a big factor because it does impact your pricing. So I made a little chart here of what exactly it does mean. So the scenario we're looking at here is, let's say you're looking to buy a house for $1.2 million. You're putting down $240,000. You're getting a $960,000 loan, owner occupied single family. Well, if your credit score is over 780, the rate would be 2.875, and there would be no points there, meaning that there's no additional cost to that interest rate. If your credit score drops to between 760 and 780, the cost of that same interest rate goes up to about $1,000. 740 to 760, it's about 3,100. 720 to 740, you're looking at about $5,700 in cost. And between 700 and 720, it really starts to go up. And then 680 to 700, almost $14,000 for that same rate. Now, this doesn't mean that you have to pay $14,000 if your score is 680. It just means you're going to have to take a higher interest rate. So the other way of looking at this, instead of 2.875 all the way, is that the rate would be going up. So whereas somebody with a 780 plus score would get a rate of 2.875, somebody with a 680 score trying to buy the same house and not pay any points, the rate would be more like about 3.75% for that same scenario. So it can either cost you a 1% in your interest rate, or you could get the same rate by paying this additional cost. So you can see here, if you optimize your credit before your credit is pulled, it's really a smart thing to do. It can save you a ton of money. Now, once you're pre-approved, once we've looked at assets, income, and credit, that's the good news. Now you've been pre-approved, but to what amount? So what I generally do is, after this analysis, we'll set up, you'll get an email, we'll set up a meeting where we'll have a Zoom meeting like this, we'll do a screen share, and we'll pull up a spreadsheet, and we'll talk about your max approval amount. And this spreadsheet is a tool that you can use as a calculator. By changing the purchase price and down payment up at the top, you can see what the monthly payments are down below. And we're also looking at cash to close, right? What are my closing costs? And the analysis of this is usually giving somebody more loan than they want. And the reason for that is that, as a rule of thumb, financial planners are probably advised that you borrow somewhere around 30 to 33% of your gross income. And that's this total monthly payment number, right? So the mortgage, the taxes, the insurance, mortgage insurance, whatever goes into that monthly payment should generally be somewhere around 30 to 33% of your gross monthly income. Now, we'll allow up to 43, 45, in some cases 50%, because there might be things that we're not including in our file. You might be expecting a raise, you might be getting big bonuses that we're not including. So that's the only time that I really feel comfortable about clients really pushing their debt to income ratio to the lending limit, because there's income there in the file that we're not counting. But if we're looking at everything, generally you want to stay in that 30 to 33% range. So normally when we tell somebody this is the max that you're approved to, we start working backwards from there. The closing costs fall basically into 4 buckets. You've got your lending related charges, things like appraisal and underwriting fees and things like that. You've got your title, escrow, and government charges, which fall into the bucket of this top right area up here: recording fees, transfer taxes, escrow fees, title insurance, and things like that. And then you also have your prepaid items. So prepaid items are, as opposed to the first two, which are transactional, prepaid items are ongoing expenses that you have to pay at closing. Things like interest being collected from the day that we fund the loan, your first year of homeowners insurance, the setup of an impound account if you want to have your taxes and insurance bundled with your payment. So these are all the things that we go over. Once we do all that, then you're going to have a number, and you're going to say, okay, my budget is this. You're going to communicate that to your realtor and start shopping for a house. Then you find a house that you like, you look at the disclosures, you walk through it. Now it comes time to write the offer. When it comes time to writing the offer, some of the questions that you're going to be asked about your lender are: what are the rates? How quickly can they close? And can you waive your contingencies? And that's a big deal. So the contingencies protect your deposit. So if your offer gets accepted, again, let's say you're buying a house for $800,000, right when your offer gets accepted, you've got to put 3% of that into escrow right away. And that's about $24,000 that you're going to have to put in. Now, if you back out or cancel the contract, that seller could potentially keep that $24,000. What protects that $24,000 are these contingencies. And you leave some time period in there, and what you're communicating to the seller is, I need this amount of time to get the loan. I need this amount of time to get the appraisal. I need this amount of time to inspect the property. And during that time period, if something comes up that makes it so that you can't close the loan, or you find something out that, unexpectedly, you can cancel the deal and keep your deposit. But that's not good for the seller. So in this really competitive market, sellers like to see offers with no contingencies. So one of the benefits of working with us is, after we fully underwrite your loan, you know that you don't need a loan contingency, that the loan is rock solid. The only other thing that can really hurt us there is the property. So I'll ask a lot of questions about the property. Are there any health and safety issues? Is there any illegal square footage? Are there any adverse issues with the property that could jeopardize the loan? But if the property is good and you've been fully underwritten, then you don't need a loan contingency, which is a big deal. The other big thing to communicate, because sometimes this search takes a while, is, has anything changed in your scenario? Have you changed jobs? Have you gotten a raise? Have you gone on maternity leave? Have you used your credit in any way? Did you get a new car? Did you buy a new car? Did you co-sign on a loan? Have you maxed out your credit cards now where they were at zero balances? So make sure that you communicate to your lender if anything has changed in your scenario at the time that you're writing that offer, because you want to make sure that same underwritten approval that you had a month or two ago is still good today, right? Once your offer gets accepted, you're in contract, and that's the grand finale. So once you're in contract, now it's go time. You're on the clock. We open, the agents will open escrow. We'll get fees. We'll send you disclosures. We'll order an appraisal. The one thing that you need to shop for during this period is homeowners insurance, and you're free to shop for that from anywhere that you would like to. We now get the additional documents, which is the purchase contract, the appraisal, the title report, plus some additional documents from you, and we submit it to actually get fully underwritten with all of the other documents. Your income, assets, and credit should already have been reviewed, but we need to update your pay stubs and bank statements and show where's the money coming from for this transaction. Once we get out of underwriting, you wire your funds to close to escrow, sign the loan documents, record the deeds, we fund the loan, and it's time to move in. So that's the general overview. I think we're on time here. Yeah, 12:25, so we're 5 minutes early. I'm happy to answer any questions that anybody has. You guys can put them in the chat for us, or if you want to raise your hand or anything like that. Otherwise, let me see if we have any questions. Yeah, looks like no questions here. So if you guys don't have any questions, feel free to email me anytime. Here's all my contact information right here. You guys can email, call me, text me, however you want to get a hold of me. I'm happy to do that. Okay, we do have a question here. The names of the first-time homebuyer program. So there are two. One is Cal HFA, CAL HFA. I'm going to put them here in the to everyone. So one is Cal HFA, and the other one is Golden State Finance Authority, GSFA. So that stands for Golden State Finance. So if you Google either one of those terms, you'll go to their site, and we're listed on both of those websites as eligible lenders who can work with them. And they have all the information there about the different kinds of loans they have, the eligibility, the income limits, the price limits, the loan limits, and things like that. So you should be able to get all of your questions answered there. You got it. Any other questions on anything? All right, you guys, we're right on time. So that does it for this webinar. Like I said, this thing could take 8 hours. Each one of these is really complicated and deep, but I wanted to give you guys a good overview of kind of the process, what's important, and hopefully you learned a little something here along the way. So thank you for joining. And like I said, if you have any questions, feel free to reach out anytime. Oh, wait, there's one more question. Are moving small amounts of money after pre-approval okay, or should they be frozen? Small amounts are okay. So when we talk about not moving any money around, I'm talking about large chunks of money moving from one account to another. I had a client one time who was just, it seemed like he was kind of addicted to this. So he would move everything from one account to another. He'd pay down one credit card balance, max out another to combine it with another, and did a lot of stuff like that. Trailing all that money is an issue. A couple of $1,000s doesn't matter. Again, remember, we're not going to ask about sourcing of anything less than 50% of your gross monthly income. So if the gross monthly income in the file is $10,000, we would only be sourcing things that are more than $5,000 in terms of movement and deposits and stuff like that. All right, you guys, have a great day. Enjoy the rest of your Thursday, and we'll see you soon.